All right, well, we've got breaking news out of Washington, D.C. We finally have the draft tax bill out of the House Ways and Means Committee. This is the starting point for tax reform and tax legislation for 2025. We have the biggest tax overhaul that's going to happen next year if this bill doesn't pass. So the critical thing I want to walk through is what's in the bill and what's out. There's a lot of surprises I had as I looked into the bill for small business, individuals, large corporations, estates. Every piece of the tax code is touched in this bill. So in today's video, I'm going to break down what's in and what's out and where are the big wins for small business owners. Now, as I dig into the bill, I want to note a couple of things. Small business has some wins here. Individuals have wins here. Big business, there's not much in there. It's kind of status quo, which is good for them. So we'll talk about that as well. But then later in the video, I want to get into what does the process look like? What's happening next? And when is this going to go into law, or where can it be derailed? Okay, there's a couple issues that are still in this bill that even when they release this, they're like, we haven't figured this piece out yet. So let's dig into the bill here. The first thing I want to hit is small business. 199A, that is the small business deduction, 20%. If you make 200 grand a year as a small business deduction, if you make 200 grand as a small business owner, you get a 20% deduction on your income. So you're only taxed if you made $160,000. That's huge. That is a big deduction for small business owners. Now, this is set to expire this year. Huge news on this. This is massive news on this one. The deduction, not as only is it being extended, it is being made permanent in this bill. It's not a 10-year extension like they did in the first time when they passed this. It's going to be made permanent, and it is a 22% deduction. They are increasing the deduction. Now, if you made $200K, you're getting 22%, $44,000 deduction. It's a greater deduction, more value for small business owners, and it is being made permanent. And that's important because corporate tax for big corporations went from 35 to 21% in last tax policy back in 2017. And small business got this 20% deduction, but it was only for 10 years and it was going to expire, this is the last year. Expiration is around the corner. It's going to be made permanent, and it's going up to 22%. Huge win for small business owners. That's probably my favorite piece in the bill, I have to say. So that's big for small business, permanent 22% for QSBS. That's qualified small business owner deduction. Any small business owner, S corporation, sole proprietorship, LLC, general partnership, you get to take this deduction on your tax return. C corporations, which are mostly large businesses, those got a different deal. That was made permanent already, 35% down to 21%. All right, let's talk about individuals next. This is big. There's a lot of things working for individuals here that is good. The bottom line news is everyone's going to be paying less tax if this bill passes. I don't care if you're at the highest tax bracket or you're at the lowest tax bracket. What happened? We got to go back to 2017 when last tax legislation went into effect. Is they said 10-year window. Also, they had to do it under 10 years, I should say, in 2017 is when it went into effect. But that's expiring this year, all right? So what's going to happen is all the individual rates, which went down, went from 39.6 to 37. Everybody's bracket went down by 2 to 3%. Okay, I don't care, low income, middle income, high income, everybody's bracket went down, meaning you got a lower tax rate. That's all going to expire, and they're going to all go back up to the higher rates. Well, that is also going to be extended for another 10-year window here to the lower rates. And what's going to happen on this one is there's a lot of little additions on deductions and credits that I want to break down too that are also going to be extended or be made permanent and that are going up as well. So, but first, rates are going to stay lower for everyone. Now, the one that was on the bubble that everybody has been talking about and didn't know where it was going to land was the highest rate for those making $2.5 million or more. So Trump had said he was going to make a new rate of 39.6, which is the old highest rate. Now the current highest rate is 37, and that's what's in the bill. But he said he's going to put a new rate on the top for the highest income earners, $2.5 million or more, that they'd pay 39.6%. That was not in the bill. Okay, so the highest rate will still be 37% under this new bill. The 39.6 might be a negotiating chip that gets thrown back in the mix to get some of this other stuff passed. We will see. This will only affect the uber wealthy. Those are making $2.5 million or more. But right now, the highest rate, 37%. Big news is that will be extended for another 10-year window and will continue to have lower rates. All right, the SALT deduction. Okay, this was one that was going to, this is probably the most dangerous provision in the bill, state and local tax deduction. This was a deduction that you can take on your federal return for taxes you paid to the state and local governments. For example, let's say you live in California. You made $200,000 of federal taxable income. And let's say you paid $30,000 to the state of California in federal income tax. Well, on your federal return, you only get to take a $10,000 deduction. Right now, under the current law, there's a cap of the state and local tax deduction that doesn't let you take more than $10,000. The problem is you had to pay tax on that 30,000 and there's 20,000 you don't even get to take a deduction for. So you're losing out, you're paying tax on money you don't get to take a deduction for. So the federal tax system is taxing you on money you already had to pay to your state. It's a tax on a tax for income you never even had because you had to pay it to the state. So it's pretty unfair if you really think about it, but they put a cap on it, $10,000. This came about in the last round of tax legislation, again, back in 2016, 2017, first year. And when that was enacted, there used to, before that tax bill, by the way, there was no cap on state and local tax. You could pay $1 million of state income tax and you get $1 million deduction on your federal tax return. However, when last tax legislation was passed, this was some of the stuff they had to do to raise revenue. To pay for all these other tax cuts, they had to raise revenue in certain areas, and this was a way they raised revenue. So what they did is they put a cap, $10,000 on your state and local deduction. Well, here's what's sorting out in the bill, and this is the dangerous part of the bill because there are politics to these tax policies. Now, what we have is we have narrow margins in the House and the Senate. The House and the Senate, there are very narrow Republican margins. Trump's pushing to get this passed, but there is a band of House Republicans holding out saying, we're not going to vote for this bill unless you remove the cap. Now, what's going to happen is at the end of this year, the cap goes away. The $10,000 cap goes to nothing. So if you're a House member in California or New Jersey or New York or a state that has a high state income tax, you like no cap because your constituents have to pay a high state income tax and your constituents win. However, if you're a House member in Florida or Texas, where you have no state income tax, you might have your local property taxes, and I get those can add up, but generally it's less of an issue there. So what's happening is some of these Republicans from high income tax states are holding out on the bill entirely, saying we are not going to vote for this at all if there is a cap on state and local tax. It is unfair. You're making us pay federal income tax on money we had to send to the state. We're paying tax on income we never even had to the federal government. It's insane. And it's a valid point, right? I mean, if you made 200 grand and you had to send $30,000 to California, you really only had 170. The federal government taxes you like you still made 190 because you only get a $10,000 deduction. And so they're saying, we want to get rid of that. That's what these House members that are banding together, they're trying to hold out on this bill. So the cap right now in 2025 is 10,000. In the bill, the answer that they had in the bill was they're trying to negotiate here. So they upped the cap to $30,000. Now, this is probably where this is going to go. It might not land at 30K. This is going to get negotiated. I'm sure there's going to be amendments all over the place. It's going to go back and forth through the House and Senate. We'll go through the process here in a second. This is the starting marker, though, of where everything goes from. So right now, what's in the bill, state and local tax deduction is capped at $30,000. That is an increase from 10. So it's still a winner for those people in these states that have a high state income tax that are paying it. They get to increase the amount of deduction they get to take on their federal income. But this is the one provision that Republicans themselves cannot agree on. Those House Republicans in the states I mentioned earlier, the high income tax states, are banding together and threatening to hold out on the entire bill. They're going to hold the whole bill hostage on this one issue. So we'll want to stay tuned on that. That's a contentious issue. And I'll be, of course, updating you on the channel here. So make sure you're subscribed if you're not already. All right. Next is tax on tips and overtime. All right. Now, there's been a lot of uncertainty about how this was going to be dealt with. One of the things floating out there was a $10,000 deduction on overtime pay. That is a bill already out there right now. But what's in this proposal right now, the legislation that House Ways and Means, you can go to my page to read the whole bill. It's 398 389 pages. The link's in the description below. But what's in the bill right now is a provision that makes income from tips and overtime not taxable until 2028. Okay, they can't fund the thing forever, so they gave a little window and say, well, we're going to not tax it for at least until 2028. I'm not sure if that's where this is going to land. It might be a cap deduction on at least overtime pay, possibly on tips as well. We'll see where that lands. Right now, though, no tax period on overtime or tips up until 2028. Okay, so the bad news is there's a shorter time window on it. The good news is none of it's taxable. There's no cap on it at all. All right, next, individual tax rate. Next on the individual side, excuse me, is the increase of the standard deduction. This is probably the best deal individuals got in the tax policy that really favors middle income and lower income taxpayers. The standard deduction is what you get to take on your tax return if you don't itemize. Most high income earners will itemize their deduction because they'll have higher mortgage interest, higher charitable deductions. They'll have other things that they write off on their tax return. And those other things add up to more than the standard deduction. So for higher income earners, they're itemizing typically. Lower or middle income earners typically take the standard deduction. They might be renting, so they don't have mortgage interest. If they're donating to a charity at, let's say, 10%, their church or whatever, their income, if they're making 100 grand, they're donating 10,000. And so they're not exceeding the standard deduction amount. So that's what most middle and lower income earners do, is the standard deduction. Now, right now in the code, it is doubled. So tax policy, again, back in 2017, 10-year window, Congress doubled the standard deduction. That's going to expire. It's going to go back and get cut in half. Now for 2026, I just want to go over the numbers here on where that's going to. If you are a joint taxpayer right now, you file married filing joint, your standard deduction right now is $29,200. If you're single, it's $14,600. Next year, married filing joint, it's going down to $16,600. That's not good. Your deduction is almost getting cut in half. What this means is if you make $100K a year, married filing joint, you get to take a $29,200 deduction, essentially $30K. You're only taxed on $70,000 of income. You get a $30,000 deduction, reduces your taxable income. Well, the problem is it's only going to be $16,000 next year. So now you're $100,000, you're taxed as if you made $84K. Okay, so that's the problem with where the current law is sitting right now, why it's punitive to middle or lower income taxpayers who like the standard deduction and got it doubled back in the last tax legislation. Well, we're going to keep the doubling of the standard deduction that is preserved in the bill. And so it's going to be over $30,000 for those married filing joint, $15,000 plus for those single taxpayers for 2026 moving forward as well. So big win there on the individual side with the standard deduction. And this is one of those things that's nice. You don't have to have some weird tax thing you qualified for, right? You don't need some charitable contribution you made, or you didn't need to buy some like energy efficient thing or a solar thing or hit some government incentive. Everyone just gets it. It's like, all right, let's give everybody the same standard deduction across the board. Keep it simple. And that's what really benefits lower middle income earners. All right. Next thing is child tax credit. Excuse me. The child tax credit. This is going up. Okay, right now the child tax credit is $2,000. This is what it is in 2025. If tax policy isn't extended, it's going to go down to $1,000 in 2026. Okay, this is another thing only done for 10 years. It's going to go away. In the bill that is now released, child tax credit is $2,500 per child. Okay, not only did they keep the extended amount in the new bill, they increased it up to $2,500 per child. Huge win for families or those planning to have children. The child tax credit not only is preserved at the higher amount, it went up to $2,500. All right, let's talk about dying. Okay, I mean, this hits your tax return too at some point, the estate tax. Right now, the estate tax exemption is basically $7 million is where it's going to go. If tax policy isn't extended, this bill doesn't pass, we're going to go to a $7 million exemption for estate tax. What that means is, let's say you die with a $10 million estate next year. And you need to pass this on. Maybe it's a small business or a family business or the family farm or whatever. And well, that wealth is only 7 million is exempted. The other 3 million is subject to tax, and that estate tax is almost 50%. So 3 million in that example would be exposed to the estate tax. You'd send $1.5 million to the federal government just for the estate tax. Now, a lot of people generally don't like the estate tax because their perspective is we were taxed when we made it with an income tax. We're taxed when we spend it on a sales tax. We're taxed when we own it as a property tax. Now we're taxed when we die and want to pass it to our kids. And so that's the concept there. The other side of the spectrum is these people are already rich. What's the problem? Let's go tax them. And there's kind of a redistribution aspect to that. Not meant to be political, but that's the tax, kind of just the policy thinking between the two different viewpoints there. Now, what's happening in the bill is the estate tax exemption is going to go to 15 million single and 30 million married. You can basically double it if you're married. So that's huge. It's basically preserving the pathway we're already on the estate tax deduction and preserving it for larger estates. I mean, if you're still the billionaire dying, you're going to have to deal with the estate tax. So you're like, most of them are giving a lot of money to charity. But for those with the small business or the family farm in the millions or single digits, this helps them so that they can keep that within the family without having to sell it to pay for the tax. All right, that's the estate tax deduction on the individual side. Now, there's a lot of things in the bill we don't know. There's some confusion on what they're doing on Social Security. It looks like they're going to for the no tax on Social Security. There's a number of proposals going around on that to just no tax on Social Security, period, which Social Security payments are only so much. So it's not like you need a cap there. There's other ways, though, that they're trying to deal with it by giving a automatic credit back as well. So we're still waiting to see how that's totally going to be done. Honestly, in the 389 pages, all the different Medicare and different Social Security things were a little hard to figure out. Everyone in the news reporting so far is all over the place on it. So there's not a lot of clarity on this, but we'll come back on it. And also there's, like I said, there's amendments and other bills already pending on some of this stuff right now. So, okay, here's one that is still on the table for individuals: carried interest. Carried interest is something private equity owners typically use, mostly wealthy owners. Trump said he was going to kill private equity, the lower tax rate for something called carried interest. This is something when they invest in a business and sell a business, they get to keep the lower capital gains treatment instead of ordinary income treatment. And the concept there for them is hey, this is more like we're investing in growing businesses and adding value to the economy. We should get that as capital gains, not taxed as ordinary income. That's the private equity, viewpoint on it. But Trump has said he doesn't like the deduction and think it's unfair, and he wanted to get rid of it. Well, he did not. Okay, so at least I say the House Republicans, even though Trump's hands are definitely all over the fingerprints are all over the bill here. But the carried interest deduction is still alive. It has not been killed in the bill. Again, that could be one of the things coming back in negotiations. So here's a couple things to watch out for in the bill. One is this millionaire tax. Okay, the 39.6% for those making 2.5 million or more. Okay, that seems like it's a negotiating chip right now that the president or House Republicans might use to get other people on board. This could be moderate Democrats as kind of a bargaining chip to get them to agree to some of these other provisions. The second item that's going to be a bargaining chip is SALT, state and local income tax deduction. Again, the cap went up from $10,000 to $30,000 cap. There's a lot of moderate Democrats and moderate Republicans in high tax states that want no cap, because that's what's going to happen if this bill dies, is there's no cap on it in 2026, because that cap was put in the earlier tax policy, again, with the 10-year clock. So SALT, state and local income tax deduction, $30,000 cap, that might go up in negotiations. Maybe that goes to 150. Who knows? That's definitely going to be a bargaining chip as well. Now, the other one to watch out for is corporate tax. Okay. No changes on that. There is right now, the corporate tax is 21%. That's preserved in the bill. That was unaffected. That was already made permanent. But the corporate tax is going to be 21%. It was moved from 35 to 21 in lax tax policy. Now, there was going to be a provision, and this might still come about, of a 15% corporate tax rate for C corporations, larger corporations that manufacture in the US. Okay. Didn't see that in the bill. So we'll see again, that could be on the table as well as a bargaining chip coming up in the future. All right. The next thing I want to talk about is just process right now. So what was released, this text, and they call it the draft bill, 389 pages. Again, you can go to the link on my website to go read the bill. I also have a summary from the House Ways and Means Committee that'll be up shortly. That's very good. Reading a bill is complicated. Reading news reports, frankly, half of them are wrong as I've been reading them and source checking them. Everybody's trying to be first to print on this. So I'm giving you the stuff that's for sure here that you can rely on, like the 199A, 22%, deductions for small business owners being made permanent. I sourced that directly out of the bill text. The tax rates being maintained at the highest bracket of 37%, definitely in the bill. The child tax credit, $2,500, up from $2,000 and up from $1,000 if even the current bill isn't extended. That was big. And then the doubling of the standard deduction. I think those are the biggest items. Again, no tax on overtime or tips. That is up until 2028. That's not permanent, but there is at least a few years. You'll get 26, 27, and 28. So that'll be 3 tax years that will get the no tax on tips. And then, frankly, Trump will be out of office, and maybe that's why they decided to go to that point, or the current people in the House and Senate. I don't know why they went to 2028. So, all right. So here's process. House Ways and Means Committee is where tax policy is generated. They're going through the normal course here. This is the starting point. It's got to get through committee. The committee will vote on it, and then it goes to the full House floor. Now, the House Speaker, Speaker Johnson, has said that they will have this done by Memorial Day. Maybe. We'll see. Okay. Who knows? And maybe the Republican Party all falls in line and they pass it on party line votes. We will see. But that is what the House is saying. They will get this done by Memorial Day. That's only a couple weeks away. Then it needs to go to the Senate, and the Senate has its own process. And this is probably where the bill is going to be going through in June. And the Senate's going to be very active, of course, and interested in what the House is doing. But this is going to go through the Senate process, and then it needs to pass in the Senate. Then what happens is the House and the Senate go through reconciliation. Okay. Whatever the Senate passed, the House is going to look at it. And whatever the House passed, the Senate's going to look at it and say, all right, we got to make sure this stuff matches up. And then they come to agreement on a final bill and send it to the president for signature. So now President Trump, along with the House Republicans, are saying they should have a bill done by July 4th. We shall see. I'm hopeful that they do that. I think a lot of the provisions in this bill are good for individuals and small business owners. There's some other things we're going to still be looking out for. Bonus depreciation. There's some new retirement accounts and college savings plans actually in the bill too that I'm going to be reporting on. We'll do a separate live and some videos on that. So make sure you're subscribed. There's a lot going on here, guys, is what I want to say. So big takeaways though. A lot of wins here for individuals with lower rates, double standard deduction, child tax credit, no tax on tips and overtime. Also, small business owners, huge win. QSBS is not only preserved at 20%, not only extended for 10 years, it's a 22% deductions for small business, and it will be made permanent. Please make sure you're subscribed to my channel. I'll be giving you updates on this bill, on tax strategies you can use to save at any time. Whether you're looking at policy or you're planning for today based on what the law is. That's what my law firm, KQS Lawyers, does every day. You can get over to kqslawyers.com, work with one of our tax attorneys to make a tax and legal plan that makes sense for your situation, and that gets you on a structure and plan that's also protecting your assets and helping you build wealth.